see pick up within the sector.
Pretty much. All right, joining us again just for quick introduction sentiments to this conversation. We're joined by Anne Wasera, who is an investment analyst, Saiton Investments. Anne, good morning, and we're happy to have you around. Anne, in just 15 seconds, would you describe as the performance of the banking industry in 2021, Anne?
Thanks for having me today morning. I'm Anne from Saiton. So for the banks, we've seen an improved performance, just as Faith has indicated. We've seen their income grow as very high, especially given the waiver of the mobile fees transaction earlier this year. And we've seen, as much as the environment is risky, we've seen their NPL ratio, the bank's NPL ratio or asset quality continue to improve, and we expect to see this in the near future should the effects of the pandemic continue to ease down.
Pretty much. All right. Next up, just before we dive into that conversation, we also have George Manga, who is an economic analyst and managing partner at MG Kenya. George, happy to have you around, sir. Your introductory sentiments, the general performance of the banking industry 2021, especially after a tough 2020.
Elijah, I think the banking industry has performed, they have posted a very strong performance in 2021. If you look at their results for quarter 3 2021, most of them have registered between 30 to around, there's one that's realized even 1,026% percentage growth in their year-to-date profits for Q3. But just look at the industry in three tiers. The top tier banks have performed very well. Tier 2 banks have also performed quite well, but tier 3 banks still have not performed quite well. In fact, most of them have made losses for the third quarter 2021. So you must look at it vis-a-vis that. And then again, just to say, our economic growth for 2020 coming 2021, 2020 Kenyan economy grew by only 0.6%, but coming in 2021, I think we've seen quite some strong rebound, and we're expecting to grow by around 5.4%, which I think will be achievable by the end of this financial year. So, Elijah, in summary, I think the banks have been resilient, and that has been shown in their Q3 performance.
Yes. Pretty much. All right, let me introduce Arnold Nkisale, who's a microfinance banker, to the conversation as well. Arnold, good morning, sir. Let's get your introductory sentiments on the performance of the banking industry in 2021. Do you share the same sentiment that the CBK, who's the regulator of that industry, and the panelists that we've spoken to this morning about the resilience of that particular industry in 2021, Arnold?
Thank you so much, Simba. Thank you for having me. Yeah, I think I share the sentiments of my fellow panelists this morning. The banking industry has demonstrated a lot of resilience. Actually, we've seen a lot of growth as far as the balance sheets sizes are concerned, asset quality is concerned, because banks essentially adapted very quickly to the effects of COVID-19 and what happened in 2020. So I think in 2021, we saw a lot of resilience and adaptation. And as you mentioned, crucially, CBK played a part, particularly by holding the CBR rate at 7% throughout the year. It was very intentional and very conscious, just to try and ensure that access to credit, as far as the general economy is concerned, is viable. So yes, a lot of resilience has been shown. Again, George has mentioned something extremely important by looking at the layering of the banks. I think if you look at the general perspective, resilience has been shown. But if you look at the tier 2 and tier 3 banks, we still have a lot to do, because I think for them, it took a little bit longer to adapt, probably because of infrastructural issues, probably because of business models. But generally speaking, we've seen a lot of resilience as far as 2021 is concerned.
Pretty much. All right. In the studio, we are also joined by Abraham Mudhogo, who's a financial expert and CEO Miradi Capital, Abraham. Good morning. We are at that point where we're looking generally or picking your first 15-second sentiments on the performance of the banking industry, especially after a tough 2021. The general feeling in the room already is that, well, this particular industry has been quite resilient to the effects of the coronavirus pandemic, and that would continue, especially into 2022. Do you share that particular sentiment?
For me, I look at it differently.
Yes.
The first thing, if you look at it, number one, there was a lot of write-backs.
Yes.
So that contributed heavily to their interest income.
Yes.
Number two, there was also a lot of push towards non-funded income, that
Yes.
is commissions and other things. And then number three, banks, as much as they made a lot of money, they were very, very cautious. So because what they did, they were consolidating. They were lending to existing customers and sectors that they were sure about.
Yes.
So going to the next year, are we going to be able to replicate what has happened? Maybe not, because whatever you could write back, you have written back. So now, and then this coming year is also starting with its own challenges.
Yes.
New variants. So it's the ones who make more money are the ones who are able to completely transform their model.
Yes.
To away from what we were always used to, especially from non-funded the non-funded income.
Yes.
So for me, yes, the resilience has been there because
Yes.
it's true they have survived it.
Yes.
But as to whether they'll continue making the kind of money they're making will depend on how well they can adapt to a new model, to a model that adapts to the new environment.
Pretty much. All right, let's dive into it then this morning. And I would like to open officially this discussion with our Faith Atiti, who's a senior research economist at NCBA Bank. Fantastic. Let's look at that data that we have for you this morning. And there's going to be a flurry of it, really, because there are a lot of conversation points that we can pick this morning from this particular industry. And if you look at banking sector, total assets, you will see that indeed the general trend from 2020 to 2021 up to where we are, that these have been looking up. But then there's a caveat to that we're going to introduce into this conversation, because the biggest contributor is going to be revealed in this conversation as well. All right, let's move into the second one as well this morning. When you look at banking sector total liabilities, you will say that indeed we're going to close 2020 without having dropped just a little bit, because we do know when we're talking about non-performing loans, we do know that did jump 14.6% in 2020, and then we had it come back to around 14% again in 2021. We're going to talk about that as well this morning. Let's move on to the next one as well. When we're talking about banking sector total liquidity ratio, the average, as we do know, is that in 2020, we're actually talking about 20% more average from where it actually needs to be. So the banks right now in 2021, quite liquid. That has been the conversation around the liquidity in the banks right now. All right, Faith, let's jump into it then. This growth that we are talking about, what we do know is that what was headlining the banking industry in 2020 was mass provisioning for either non-performing loans or bad loans as well. So when we look at this jump in 2021, should we look at it single-handedly or separate it from what we like to call a rebound from the slump that we saw in 2020? Which therefore makes me ask you the question, should we wait a little bit longer before we say, well, the banking sector or the banking industry has been quite resilient? Should we separate what a generic growth is from a rebound from 2020, Faith?
Thank you. And that is certainly a good question. So should we say the banking sector was resilient despite the numbers as you've outlined? Certainly, yes. Of course, when you're looking at resilience, you look at it a whole more broadly than just looking at the income per se.
Yes.
First, the sheer fact that we didn't have many banks, if any at all, are reporting losses through the period, despite that heavy provision into 2020 just underscores that level of resilience. Yes, we had provision sort of distorting the way you literally should look at bank balance sheet at the moment. But this was, of course, a global phenomena. The measures initiated to make, remember, in any economy, the banks are the center of it. If you remember the global financial crisis, it started with the financial sectors. Most crises we've seen in the past, if they are not originating from the financial sector, they tend to be exaggerated or aggravated by shocks to the financial sector. So it was imperative that the government and the central bank respond the way they did.
Yes.
Coming into 2021, certainly we've seen this right back, which just suggests that risk as had been envisioned at the onset of the pandemic did not crystallize as was initially expected. Yes, most banks, it's prudent that when faced with risk as a bank, you do make provisions. You gradually make provisions so you're not hit immediately. And of course, we've seen a lot more stringency in the way we do provisions with the adoption of IFRS 9 or the more latter accounting measures, Basel 2 or Basel 3. The accountants on call maybe could have more insight on that. So should we strip out this provision to just outline the level of resilience?
Yes.
Certainly, yes. There is that aspect that you need to sort of sieve out when you're looking at it, just to underscore how strong the banks are. But even if you had to sieve out that, you'll still have at worst profits declining rather than outright losses for the banking sector,
Yes.
which still underlines just the level of resilience for the sector.
Yes, pretty much. All right. Now, George, I just want to bring you in as well. Just quick sentiments on that as well. I mean, when we're talking about this growth, George, in a 2020 to where we are in a 2021, I mean, yes, you call it resilient, going by the absolute numbers that we're looking at, but then should we just call it a rebound and then separate 2020 from 2021, George?
Elijah, if you look at the top banks, and
Yes.
I want to pick just a few, next of KCB, 25.2 billion profit in 2021, which is NBK, which is subsidiary of KCB now, posted 1.1 billion profit. That's the
Yes.
PBT from 87 million last year. That's 11.26% growth. Equity posted 26.8 billion vis-a-vis 15 billion last year, which is almost 78.79% growth.
Yes.
And then lastly, Cooperative Bank posted 20 billion PBT against 10.1 billion last year, which is 19% growth.
Yes.
So if you look at those metrics, Elijah, vis-a-vis what we posted last year, and then vis-a-vis what we posted in 2019, then you realize if you look at 2019 vis-a-vis 2021, there's a slight growth. But if you look at 2020 vis-a-vis what we have posted in 2021, then you realize that there are very huge jumps. One of the main reasons to this is that there was heavy provisioning, just as my fellow panelists has put it, in 2020. And therefore, coming from that level to where they are to date, there is that huge jump in their profitability. But Elijah, there is, as I said earlier, when you layer these banks in tier 1, tier 2, and tier 3, tier 3 banks didn't fare very well. In fact, currently we have problems with Spire Bank that I think central bank has a very big problem with because of liquidity challenges. The same to the other tier 3 banks that didn't post very strong performance in quarter 3. The likes of UBA, the likes of EcoBank, and so forth. But that notwithstanding, if you look at the overall industry, then we can say with certainty that the industry has reported very strong performance in 2021 vis-a-vis 2020. But that underscores also the resilience of the Kenyan economy.
Yes.
If you look at the Kenyan economy vis-a-vis our peers in the region and even the global economy, that is sub-Saharan Africa, the average growth in 2021 was negative 1.8%. Yet Kenya reported a growth of 0.6% in 2020. And then come 2021, the average growth in the sub-Saharan Africa, I think, is forecasted around 3.4 vis-a-vis 5.4 in 2021 for Kenya. So the banking sector now mirrors what our general economy looks like. If you look at it in terms of GDP growth vis-a-vis the global economy, and then vis-a-vis our peers. So in a nutshell, Elijah, I think we expect the banking sector to perform even better going into Q4 of this year, and then going into maybe Q1 and Q2 of next year. We don't know how the elections will look like next year, but we expect if things are the way they are to date, then the banking sector will remain strong. Then lastly, Elijah, let me just put this point. There were measures that central bank put in very clearly as the pandemic was starting, and I think that cushioned the banks very much to enable them circumvent or enable them go through the pandemic. One of them was to lower the CBR rate to 4.2%. What this in a sense did is to push in liquidity back to the banking industry, so that at least with the pandemic they could have that leverage to be able to invest in other assets other than loanable funds. And that tells you, if you look at the CBK metrics, almost 76% of the liquidity in the market went either into treasury bills or treasury bonds. And you saw those are very secure assets, so to speak. So that is one of the areas that I think gave a lot of leverage in the banking industry. Two, the lengthening of the repurchase agreement, which was pushed from 28 days to 91 days. That also pushed a lot of liquidity in the market. And then, of course, the restructuring, the allowance for restructuring that central bank gave to the bank, so that classification of assets was relaxed, so that if a customer was not able to pay last year for maybe 1, 2, or 3 months, then they were not classified as bad debt %, but they were allowed to restructure those facilities. So I think those measures have played a big role in what we currently see in the performance of the industry. Elijah.
Pretty much. And let me jump to you as well before I jump to Abraham and Arnold this morning as well. And let me just, there's a start here, especially when we compare where we are from Q2 of 2020, especially to Q2 of 2021, where banks' assets, they jumped by 12.4% from where they were in Q2 of 2020. I mean, they jumped to about 5.679 billion. That's a big jump as well. Again, when we look at loans and advances and securities, they accounted out of those assets that we're talking about, and they accounted for 50%, that is loans, and 30% of net assets in December 2020, compared to now a jump again when you look at Q2 of 2021 of 54.8% and 31% in June 2021. Those are loans and government securities. So loans accounted for 54.8% and 31% of government securities to those banks' assets in June 2021. So, and indeed, you could say that now us saying that this could be separated from the growth in 2020 is clear, because you can actually see banks started lending heavily as we got into 2021, because they were sort of coy to lending in 2020, which is why I'm still asking, can't we separate that growth from 2020 to 2021 and say, hold on, this could be a rebound. Let's compare 2021 and 2022.
Thank you for that question, and I really do agree.
Yes.
First, we have to separate, because remember, 2020, the whole from March to like December, we had the effects of COVID, and banks didn't want to lend out to businesses or customers or even the private sector, given the credit risk that they perceive when lending out to these customers. But you see, in 2021, when the loan window, moratorium window expired, the growth, as we've seen, the GDP started improving. So businesses started going back to their normal activities. And then you'll see maybe from around March to, let me say, up to September, we've seen a lot of improved business environment. We've seen how banks, as you've seen in the data, they started lending out now more loans to businesses and to customers than investing in government securities. Last year, yes, they did invest in government securities heavily, so that they can just reduce the risk that is associated with lending out to customers. But this year, we've seen the yield curve decline. So you see, even for banks, they are always after the interest income. So you'll see they'll lend out more loans to customers and portion a bit to government securities as much as there is low yield. So going into 2022, given that 2021 environment will trickle down to 2022, I believe we should, and actually we can compare 2022 and 2021, and because 2020 is more of an outlier, it's giving a lot of low numbers, given that they had to provision, they had to actually reduce their strategy. So 2020 is more of an outlier, and that's why you'll see for 2021 their income is increasing so much just because of the low base effect. You see, in 2020, let's say their income was for a certain bank, let's say it was around 20 billion, but for this year you see around 50 billion. But it's just because they had to provision a lot last year. But for this year and next year, we've seen reduced provisioning levels, and we expect it to trickle down to next year. Even the non-performing loans, as much as they were a huge percent last year, this year, given now the improving business conditions, it's going to reduce or just normalize and go back to pre-pandemic levels. But a disclaimer is, with the new Omicron variant, we don't know how it will affect. Maybe its effects will be more than the COVID-19. Maybe banks will have to provision more. They'll have to put in more strict measures just to ensure they survive again, because in 2020 it was also a survival for banks, as we've seen. Tier 1 banks were able to survive. Other banks such as HF, they've been continuing to record losses over the quarters, over the years. So with this Omicron variant, if it does affect the banking sector like we saw in 2021, banks will have to do more. They'll have even to put up more stringent measures, especially into lending out to businesses. Again, we have election, and next year has a lot of uncertainty. We have election, and we don't know how these elections are going to affect banks lending out to customers. So for now, it's more of a wait and see. But yes, we can compare 2022 and 2021 with the disclaimer that 2020 was more of an outlier.
Pretty much. All right, Abraham, let me cross over to you now. And I would like to start your conversation like this. I mean, for us to look at how the banks are performed, then we got to look at that non-performing loan ratio within the industry. What we do know that NPLs increased to 14.1 in December of 2020, 14.6 in March 2021. Now they've eased back to around 14% in June 2021. Abraham, hold on. This 14% number, last year, when we got into the coronavirus pandemic, they said this 14% will not be an accurate measure of the NPLs within the economy. They said, now what you gotta do, all the loans that have been restructured, include that in the NPL ratio, so that now we get the exact figure, because we do know banks like Equity actually did extend that moratorium up to around 2023 as well. So you just can't call that performing loans, especially when they have been restructured as well. But Abraham, going by this as well, I mean, we've been stuck there. You say exactly what the CBK said last year, that they were afraid it might get to 16, 17%, but it did not. Is this a proper indication then that, well, they were quite resilient?
You see, you put it very well. I think we are comparing apples and oranges.
Yes.
Because when they're competing for 14% during the pandemic period, a lot of metrics were changed, because even the definition of what is bad and what is good changed. It changed significantly.
Yes.
So what was 14% then is not what is 14% now.
Yes.
So even to compare those figures actually is to compare two completely different things.
Yes.
What is important is how do we compute what is non-performing? Have we reverted back to the prudential guidelines of the 5 categories of normal, or what's substandard and loss, or are we still in that regime? Because what is critical here is quality of assets.
Yes.
You see, you're talking about how assets of the banks have gone up. That is quantity, but what is the quality of that asset? So it's very, very important that how we measure the quality is what is critical, and how we arrive at that number.
Yes.
So that way we are able to and use the same measures over time, so that we're able to compare that number.
Yes.
Otherwise, if every time something happens, we change the metrics, then those numbers cannot be compared, because they have to be looked at the context, under which they were put together, and the context prevailing at that time.
Yes.
Yeah.
Pretty much. And I'll clear this conversation for the resilience of the banking industry in a 2021. Just before we talk about exactly what this NPL ratio means, Arnold, yes, you said they have been resilient, but then is this a confirmation that indeed, because the fear was that in 2020, when everybody was crying about how the economy has been affected heavily by the pandemic, we're still stuck at 14.1%. In fact, the worst NPL ratio, according to the CBK, was in March 2021 when we jumped to 14.6% before we came back to 14%, the one that we actually saw in a 2020. Is that enough reason for us, Arnold, to say, well, but you see, they did not change that much, so it was quite resilient?
Yeah, thank you so much. I think several things need to be factored in.
Yes.
I think a longer analysis, it would be prudent to do a longer analysis to quantify the resilience. Yes, we've seen resilience in 2021, but it would be prudent to have a longer analysis, probably look at what will happen in 2022, as alluded to by Anne, as far as some of the changes we're expecting to see with elections coming in, with probable issues to do with the Omicron virus. However,
Yes.
from my point of view, I look at it like this. 2020 was a reset year. Essentially, everything was being reset. Financial institutions pressed the reset button, but also businesses and government entities had to press the reset button.
Yes.
So what we're seeing in 2021, several things. Banks did several things. Number one, banks did a lot of collections, resilience, stepped up collections. So if you look at what happened in 2020, there are several phases. Number one, there was an initial restructuring of facilities with the thinking that COVID-19 would probably be a 3-month or 6-month kind of event. Unfortunately, that did not happen. So it simply meant that the restructures had to go on longer and certain provisions had to be put, more provisions had to be put. So that simply meant we saw a very massive dip as far as bank revenues are concerned.
Yes.
Now in 2021, we've seen a lot of recovery. There's a lot of inoculation going on, reopening of the economy, and also intervention from international bodies. We've seen a lot of interventions by the IMF, World Bank, and also institutions like the European Investment Bank, which is has done a lot of interventions with the likes of credit Coop Bank, just to try and support the MSMEs and try to inject liquidity into the economy, and also try to force the hand of some of these banks to actually lend to clients and not necessarily just lend to the government.
Yes.
Through basically purchase of government securities. So that aspect of resilience, yes, if you look at it from a general perspective, I would definitely agree with all of my panelists that we've seen a lot of resilience. But if you strip it, if you strip down to various factors, various interventions, various indicators, then it would be prudent probably to have a longer analysis of what will happen in 2022.
Yes.
Traditionally, we've seen capital flight during an election year, especially in Africa, because guys normally tend to have a wait and see approach as how things will pan out. Again, we also see low government spending during election year, particularly because of trying to either, you'll see procuring entities either trying to complete whatever activities that they have, or you will see a lot of quote unquote campaign funds being mobilized. So again, if you factor in these raw economic activities from a microfinance perspective, then you'll be able to gauge exactly what will happen in 2022. So a longer analysis would be prudent to do a longer analysis, but generally speaking, resilience, you can say that the financial institution or the banking sector has demonstrated resilience.
Yes.
In 2021.
Pretty much. All right. Now let's go
Elijah,
on a
if I may
break.
just
Hold on. Let's go on a break like this. I just want us to come back immediately and talk about that once we come from this slight break here. But I want us to go on a break like this. I'm going to pick just 5-second responses from all of you because I want to throw a spanner to that performance just before we take that break. Now, this is it. 9 banks, that is in tier 1, accounted for 86.9% of total industry profit before tax in 2020, with the remainder, now wait for it, 30 of those banks as well in the other tiers accounting for just 13.1% of that profit before tax. Now, Now, let me throw another spanner into that. If you look at exactly how interest rates have been since 2020, you can see that the CBK has tried just to come in and throw just a cushion to the economy in that area. But around that area, what we've seen is that majority of this growth that we're talking about from these banks has not been in the mass market. Because as of June 2021, all the banks in the country, in terms of liquid assets, Treasury bonds and bills accounted for 71.1% of what they held as liquid assets. Now, let me go back to the other one because we're going to talk about that type of growth then once we come from this break. Let me start with you, Faith Atiti, Senior Research Economist, NCBA Bank. But only 9 banks accounted for 86.9% of the profit before tax, and at 2020, with 30 of them just taking 13.1%. Faith, in just 5 seconds, is it time for us to really go back and say, well, we need to debunk Kenya? 5 seconds, Faith.
Well, thank you, and I think there's been very deliberate effort towards consolidation within the sector,
Yes.
where you put more banks together, build scale, which of course has implication on pricing and competition, of course, all for the better of the market.
Yes.
But whether that will be achieved any soon remains as good as, your guess and mine.
Fantastic.
It's a free market, so.
Fantastic. We're going to come and talk about that once we come back. Let me go to George Munge, economic analyst and managing director, managing partner, AMG Kenya. George, that only 9 banks accounted for 86.9% of the profit before tax in 2020, a time when the Kenyan banks were really feeling the heat of the coronavirus pandemic, with 30 taking 13.1%. George, time for us to bring debunking Kenya to the fore. And Mike, I miss your mic, George.
Sorry, Elijah. I'm saying if you look at the stress testing report,
Yes,
from Central Bank of Kenya, that is for Q2.
yes,
You realize that several sectors took a hit from the economy. The reason why the bigger banks fared better than the smaller banks,
yes.
the bigger banks have a fairly spread portfolio. You'll find them in agriculture, you'll find them in manufacturing, you'll find them in ICT. But the smaller banks, their portfolio is quite small. You'll find them maybe just in trading and maybe in manufacturing. That is why when a shocker like COVID-19 came,
Yes.
then the bigger banks are likely to perform better than the smaller banks. And then again, it boils down to core capital.
Yes,
Most of the bigger
George,
banks
we have 5 seconds. Remember, we're going to take a break. I want to pick those points once we come back. Just 5 seconds.
Yes,
Time for debunking Kenya.
I think that is the way to go. That is the direction that central bank is trying to
Yes.
push the industry to. We need to consolidate some of these banks to more bigger and more stable entities.
Pretty much. I want us to talk about that once we come from this break. Let me come back to the studio. Abraham, that's a huge disparity. Time to debunk Kenya?
Yes, I think it's a capital game. So the mighty will survive, and,
Yes.
and the weak may not.
Pretty much.
Yeah.
All right. Let me go to Anna. Anna, huge disparity. Just 9 of the tier 1 banks controlling 86.9% of all the profits before tax in 2020. Time for debunking Kenya conversation being more serious.
Yeah, I believe a lot more conversation needs to be done on consolidation, given that we remain overbanked.
Pretty much. I want us to talk about that once we come back. Let me cross over to Arnold Gasale before we take this break. Arnold, big disparity in that. 86.9% just for 9 banks, and the other 30 are scrambling for 13.1%. Arnold, debunk Kenya or not?
Inorganic growth, as my fellow panelists have mentioned, may be necessary.
Yes.
Through consolidation and mergers.
Yes.
And it's a conversation which was there from increasing the core capital from 1 billion to about 5 billion about 5 years ago. And I think it was shelved. It may need to be revisited.
Pretty much. So once we come back, let's talk about this growth then that we're talking about, because if 71.1% of liquid assets that banks held as of June 2021 was in treasury bills and bonds, Should we question this growth? Because the same period, we've had the CBK really lowering interest rates at a time when public debt has been growing as well. Did they give banks an avenue for growth? Should we then question that? Once we come back here on a Metropol Television, you are still watching Business AM. Welcome back. You are still watching Metropol Television. Just before we went on a break, we were looking at that particular growth. Let me bring in Faith Atete, Senior Research Economist and CBA. Faith, yes, let's talk about that then. If 30 banks in the country are only accounting for 13.1% of profits before tax in 2020, and 9 banks taking 86.9% of that, is it time then for us to bring forth the conversation of let's debunk the country?
Thank you, Elijah. That is certainly a conversation that has been ongoing within the industry for quite some time now.
Yes,
Yes, there is some evidence of a concentration within the banking sector. And theoretically, it's always assumed that when an industry is concentrated, then you have in this case the banks, or rather the class of the group of banks,
yes,
who with the majority of that wallet share have more pricing power. They kind of set up pricing for the rest of the industry.
yes.
Whether there's evidence for Kenya, I think it remains subject to further research. But certainly there is merit in decentralizing this.
Yes.
If you can have more, rather lesser banks with more better distribution of the wallet share, and then the person who tends to gain is the normal 90, the person who comes to bank to borrow, because then you intensify competition. The banks are incentivized to invest more in efficiency, and of course the benefit trickles down to the borrower. So there is merit in that. Like I said earlier, if whether we see progress towards this, yes, there's been some steps towards this. The regulator is very encouraging. The players do appreciate the need for this, but yes, it's still a free market, and unless of course you make it a bit difficult for banks, I think for the smaller banks, I think they'll still want to be part of these markets, and it's still a significantly a huge market, so any player will still find it profitable, however small, to still be within this space, as long as you have the right business model,
Yes.
which focuses on the mass in this case, because I think the corporates are well banked. Where the opportunities still are within the mass market, and anyone with the right business model, however small your balance sheet is, can still benefit from this. So consolidation is still far out for us. I think we are making progress towards it.
Pretty much. Let me come back to the studio and talk to Abraham on that as well. Abraham, yes, indeed. You hear what Faith is saying. Yes, despite you might be a very small bank, but you have your pool of clients within the economy. Your balance sheet is still going to make sense at the end of the day. But this coming at a time when the big boys, let me just speak of Equity Cooperative and KCB, they've been looking elsewhere for regional investments, because it looks as if this space is already crowded for them to even think of expanding even further within the Kenyan economy. But when you look at these numbers, 86.9% of just 9 banks have a larger concentration of the profits before tax, and 30 of them just taking 13.1%. Should we bring that conversation of debunking the economy to the fore? But When you look at where we are, we've seen exactly what the Central Bank of Kenya is trying to do. Are we at that point where we say, well, we can't add any other bank because then these numbers will not make proper sense?
No, I agree with her. I
Yes.
think there's one, everybody has their niche.
Yes.
But I think the point to make here is the regulator must ensure that everybody is able to play in their field.
Yes.
And he has also alluded to something that in any market, if you don't, if the regulator is not very, very careful in any market, not just the banking sector, there's a tendency to move towards cartels or concentration, where we have a few players calling the shots for everybody else.
Yes.
It's not just this market, any market. In most economic models, if you look at them, unless there's intervention,
Yes.
there's a tendency to concentrate between a few guys who control the rest of the place.
Yes.
What you'd call monopsony. Now, in Kenya, why are the big boys going elsewhere? I think they're choosing to adopt a blue ocean strategy. That DRC has only 5% banked. It's only a 5% banked market.
Yes.
So there's very little effort to grow your market there than in Kenya, where you really have to, most of the time, for you to get a client, you're probably getting them off someone else, or somebody is multi-banking.
That's it.
You see, so maybe it's a decision they're making internally. They're saying for the kind of capital we have,
Yes.
we can go elsewhere and take advantage, because a fast mover advantage, like you see what equity has done to DRC.
Yes.
It will pay off big time, because by the time everybody else is rushing there, they'll find them there. So with the Kenya market, yes, is consolidation also the solution? Maybe not.
Yes.
Because all the banks that are there, maybe save for one or two that are maybe going down, everybody else is still making their money. Their boards are happy, their shareholders are happy, so they have their niche. So I think we just let it be. And anyway, if somebody will only stay in business if they're in business. So why are they staying on? They're staying on because they're making some money.
Yes.
But at the same time, we should ensure that there are no unfair practices that will inhibit their growth, or that will give a due advantage of the big guy over the small guy.
Yes.
Remember, in any regulatory environment, the regulator is there to protect the weak from the strong.
Pretty much. Yeah. All right, let me cross over to George. George, just before we went on the break, you were mentioning the exposure points for the smaller banks in the country. I mean, do you think those exposure points would worry us so much, George, to the point that we're saying, well, we need to reduce the number of banks within the country more and more?
Elijah was talking to you about the stress testing results, and
Yes.
Just to put it simply, I think the smaller banks are more at risk to suffer in a space where we were last year and where we are today.
Yes.
If you look at the banks that have failed before, we talk of Chase Bank that went under, and the Imperial Bank, of course. Those were tier three banks. And Elijah can tell you that if nothing is done, probably Spire Bank might go under in the next 1 or 2 years, because
Yes.
they have flouted all the CBK ratios as we stand today.
Yes.
So my opinion is that amalgamation or these banks coming together to have a bigger enterprise is the way to go, and that is what central bank has been pushing for. You saw CBA merging with NIC the other day, and you can see the results that are coming in after that merger. The same to KCB and NBK,
Yes.
and even Cooperative Bank and I think Kingdom Bank. So in my opinion, I think that is where I foresee the banking sector going. This is not a very easy sector. It's a very tough sector, and it requires a bit of muscle for you to be able to survive some of these shocks. If you look at our market vis-a-vis our peers, you look at the number of banks in, say, Rwanda or in DRC Congo, then you realize that at 43 with a population of 50,
Yes.
then probably our banks. The other bank I told you that was in Ethiopia. Ethiopia, I think 10 or 15 banks with a population around 100 million.
Yes.
So if you look at our pace vis-a-vis our peers, then you realize that we are overbanked. And that is what brings some of these tier 3 banks to go under. And when they go under, Elijah, they go under with depositor savings. they go under with quite a number of people behind them. So to me, I think we should look at maybe having between 15 to 20 strong banks in the economy that can even look across in the region what Equity has done, what KCB has done, and what the likes of NCB I think are looking into doing.
Pretty much. All right, and just let me introduce you to that as well. For you, when you look at this percentage, I know before we went on break, you said maybe it's time for us to have that conversation. But when you listen to what Faith is saying that the way the industry is positioned, even if you are a smaller bank with just a smaller number of depositors, really, once you manage your business properly, your balance sheet at the end of the day is going to make sense. Should we leave it there, knowing very well that the CBK has said they are not going to let a bank go down under their watch?
Yes, I do agree. As much as yes, you're a small bank and you know how to manage your assets and everything, yes, you can survive. But I also do agree with George. Kenya still remains overbanked.
Yes.
Even if we look at other nations like South Africa and Nigeria, our ratio is way too high at around, I think, 7%, given that we have a lot of banks in comparison to the number of population. And also COVID exposed a lot of weak banks. We've seen HF this quarter. They opened they actually asked investors who want to invest so that they can pump in liquidity. So you see, as much as yes, you're a small bank, you are prone to a lot of attacks, a lot of instability. As it had been said before we went to the break, big banks have the leeway to diversify their portfolio. But small banks, given that even you as a client, you will prefer to bank with a big bank than a small bank, since you know that it can stand the pressure, it can, whatever happens, it will still be there. We've seen Imperial Bank being liquidated. We've talked about Spire, Chase Bank, etc. So yes, as much as yes, you are small and you know how to take care of your assets and everything, small banks are still prone to attack. Small banks are still, whatever happens, let's say if the Omicron does come, I don't think the small banks will be able to survive another year of high provisions, poor asset quality, etc. So it's up to CBK, yes, to put more pressure and to encourage consolidation in the sector so that Kenya can have small but strong banks, compared to the other economies.
Pretty much. All right, Arnold, clear that conversation this morning. Just before we look now at where this growth for this particular banks are coming from and question growth vis-a-vis what the CBK and the government really wants that growth to look like within the economy. Arnold, your point on why you stand on either Kenya being debunked or being overbanked presently.
Okay, so I'm looking at it from two perspectives. Perspective number one, the reason as to why a lot of small banks came in is because of that aspect of the mass market, which the sentiments or the feeling is that that aspect or that block of the market was not being properly assisted.
Yes.
If you go back in time, the minimum amount of money you would need to have in an account was about 10,000 shillings, which was a lot of money. And this was at the beginning of the year 2000 or something. And then Equity Bank sort of changed that narrative by essentially ripping off all the banking rules at that particular point in time, and including the mass market, and to a big extent, Equity Bank are where they are because of the mass market.
Yes.
Of course, there's an aspect of high risk as far as the mass market is concerned, but how do you place yourself in such a way that you can mitigate that risk by customizing credit facilities or financial solutions for this particular part of the market? And that's why you see Kenya having a lot of quote-unquote alternative solutions through smaller banks or maybe credit-only institutions. So if you look at it from that particular perspective, that aspect of having a lot of banks or quote-unquote being overbanked as a country vis-a-vis the population is because of certain needs not being met. If you go to a conventional commercial bank as an SME client, the bureaucracies involved for you to get a facility, in most cases, certain thresholds are not viable or cannot be met by some of clients in the SME market. So these clients opt to go to somewhere where credit is expensive but is quickly available. So unless those aspects are quickly addressed,
Yes.
then the question of us having more resilient banks vis-a-vis banks which seem to understand the needs of the client will prevail. Now, technically speaking, as far as the industry is concerned, having less banks with more capital is good for the economy, of course, because of resilience, because of capital adequacy, because of capacity to absorb shocks in the event anything happens in the economy. It is good in that particular aspect. But in terms of addressing the biggest chunk of the economy, we may find ourselves in situations whereby we have few banks, but then again, we have a lot other alternative options cropping up into the market. Credit-only credit-only institutions, mobile lending institutions, and so on and so forth. We've seen CBK and, of course, certain legislative measures being taken to again curb institutions which are lending via mobile. But then again, we may need to relook at the needs of the economy vis-a-vis what the banks are offering. And that's why you'll see, as alluded to by Faith earlier, I think corporates are well banked.
Yes.
Certain elements of the economy are well banked, but what about the mass market? If we can be able to roll out and properly implement things like STAWI, the Credit Guarantee Fund, then it will be a viable discussion. However, if we don't, on paper, it will look good. On the ground, things will be different.
Yes. All right. Now, let's then talk about that growth. And I would like to start with you, Abraham. Let's talk about it. Yes, indeed. When you look at core capital and total assets to total risks-weighted assets, that's a very important ratio, especially when you look at where the banking industry is. Then you would say it has been at 16.5 and 18.9% to June 2021. Quite healthy, especially when you have to compare that it has to be at 10.5% and 14.5%. Then you will say, yes, we are fine. I mean, when you look at that ratio, we're good. But then let's talk about where that growth is coming from. It's fine, Abraham, that we're saying, well, the banking sector has been quite resilient. But one big issue is that public debt has been growing throughout that period. Now, but then again, you look at the back end of that, interest rates have remained low despite this rising public debt. Then you ask yourself the question, have the banks benefited from this? Indeed, yes, they have. Because when you look at exactly the liquidity, the hold in terms of treasury bonds and bills, 71.1% in terms of the assets that account for the banking industry as of June 2021. Quite huge, Abraham. Is it therefore time for us to say this growth should be questioned, essentially?
The several numbers you need to look at. If you look at the liquidity ratio,
yes,
it's at an average, it's above 40.
Yes.
That tells you the banks probably who are at 60 and others maybe who are at 30. That's why they average about 40.
Yes.
CBK only requires 20%. At 20% is you still within CBK, is liquidity enough to meet your depositors as they come through.
Yes.
Now, out of their total liquid assets,
yes,
70% is bonds and is treasury bonds and treasury bills. So it means that 70, that amount, either in percentage or in absolute terms, should have been lent out. Ideally, if you look at what a bank should. An asset.
Yes.
So there's growth in the asset portfolio, but that amount is starved of the market because that money was lent to the government. If you take that argument further, the government's domestic debt or debt overall is growing. It's now at 8 trillion.
Yes.
Split half for external, for internal. So the question is, if such a big portion of bank assets are in treasury bills and bonds, that means it's a very easy, it's low risk and it's quite some good return at a very minimal effort.
Yes.
But how sustainable is that? Because where is that money coming from when you think about it? That money is coming off from me and you because the government pays all the money that the government has come from taxes.
Yes.
It doesn't come from anywhere else. Of course, a bit from borrowed funds or from grants.
Yes.
But most of it is from taxes that KRA collects.
Yes.
So this model, as much as banks are here to make money, the issue of it, from where I see it, is how sustainable is this model? The sustainability of it, in the sense of one, for them, having this customer who they're able to, who wants to grow their debt endlessly. But how long will this last? What happens when the government doesn't have that kind of appetite? Then what? Then they'll be awash with all this money.
Yes.
The challenge normally happens if you do something for so long, you normally forget what you used to do. So the day this money sits with you, then again now you're going to panic mode because you'll be sitting on high, because the higher the liquidity.
Yes.
Because see, don't forget, it's a very delicate balance, because these funds cost money. So you have to pay someone for them, the deposit. At the same time, you have to lend it or do something with it to make a margin to pay this person and have a return for your shareholder. So in a nutshell, for me, that model, first of all, that banking model as it is not very useful to the economy.
Yes.
Simply put.
Yes.
It works well for the shareholders of the bank. It works well for the management of the bank, but it does not work for the economy. However, banks are not here for the economy. Banks are here to make money. They'll be like any other business. So we cannot put that on them. However, it's now upon the regulator to come up with regulations and policies that drive that liquidity away from the government towards the private sector. But again, this is now a different conversation from this table, because it again beholds on the government of how it is handling its fiscal and its monetary policy.
Yes.
To ensure that the rising debt levels are managed.
Yes.
That they start staying within whatever they have and freeing this money to come back to the economy as lend funds, especially to the MSME. Because the way it is, for every shilling that goes there is a shilling that comes from here.
Pretty much. All right, George, I want to rope you into that conversation as well. I mean, when we look at this data, especially when you look at it up to June 2021, George, deposits made 74.8% of total banking sector liabilities and shareholder funds at a time when, if you look at those liquid assets that banks will actually have, 71% of that is tradable treasury bills and bonds that were held by banks out of June 2021. George, a time when, I mean, you like to think that we're having this conversation about how 2021 growth of the economy has corresponded to the growth of the banks. But George, going by this data, you might say that indeed it's not the case, because it looks as if when banks are enjoying the low interest rates that the CBK is setting, it looks as if we are opening up an avenue to lend more and more to the government. It's a sure bet for banks, even at a time when we celebrated the cash reserve ratio being reduced to 4.25%. George, should we celebrate some of these intervention measures that have been geared to sort of supporting the banking industry, but now they look as if they were opening an avenue for the government to get more money? Because on the other side of that, public debt has been rising, George.
Elijah, thank you. I think sometimes you are tempted to say that probably the 2021 or 2020 profitability and then 2021 Q3 growth for most of the banks in the industry is cosmetic, so to speak.
Yes.
But I think that is how the economy was then, and probably in the last few quarters.
Yes.
If you look at the CBR rate at 4.25%, that I told you pushed a lot of liquidity back into the banking industry. Same to the repos, the repo agreements that were increased to 28 days, 91 days. So central bank essentially gave a lot of liquidity to the banks. And then on the flip side, the treasury bills were trading at between 7.2% to around 8.5% over the last I think 1 year or 1 year and two quarters.
Yes.
And coupled with the appetite that the government had for borrowings, especially in the domestic market, because that's what we're dealing with, then it tells you why most of the tier 1 banks made very easy money within that period. And then remember, Elijah, that last year the growth in loanable funds last year was very, very minimal. I think it was around 4.25%
yes.
for the whole year. So that essentially means that the commercial banks had a lot of liquidity in their treasuries that they were not willing to push to the private sector,
yes.
but push to the public sector. And then you know that public sector debt is almost risk-free. So it is just monies you picked from client A, B, C, and D and give to government and expect returns back. But maybe that is not going to hold in the next few quarters, in the next few years, because already government is already overborrowed. So maybe the latitude they have to borrow is not very huge.
Yes.
And also, of course, the treasury bills rate are likely to go higher as public debt piles. So that is a strategy that might have worked in the last 1 year,
Yes.
in the last 1 year, 2 quarters, but it might not work in the next few quarters to come in. So I think banks must start again thinking on how to push loanable funds to the private sector as it used to be, because then again, Elijah, that is what spurs economic growth in the economy. You don't grow the economy by lending to government, because then government is always just consuming. So I think in the next 2, 3, or 4 quarters,
Yes.
the banking industry will want to try to push as much credit as possible to the private sector, so that it spurs again the economic rebound in that space. But if they stick to just investing in T-bills and T-bonds, then maybe that's a short-term strategy, but not a long-term strategy, Elijah.
Pretty much. All right, Faith. Now let's start with that word, cosmetic. I mean, if you go to exactly how that growth has been. Remember, we said, yes, you might say they have been resilient looking at the numbers. But then when you look at where those liquid assets are, to the tune of 71.1%, and then when you look at all the policies, Faith, that were quote unquote supposed to come in and support the economy and make sure that the commercial banks in the country remain afloat, it's like they open an avenue to lend to the government, Faith. So should we question this growth and probably go back and say, maybe not resilient, because public debt is now a big concern? We saw the other day, just before we close 2021, Okuriatani saying, if he says that everything is correct or right in the way that the government is borrowing, he will be lying. Meaning, whether we like it or not, we have to change that strategy. So if we change that strategy, Faith, in 2022, are we going to look at banks again falling down from resilience to where we were back in 2020? Faith, please respond.
All right. Thank you, Elijah. And I wouldn't question the credibility of the central bank from a supervisory perspective.
Yes.
By agreeing with the cosmetic implied by our friend, George, rather. Yes. So we want to believe, yes, there is some rigorous supervision and audit that goes into the numbers to give it some credence. But that said, like you say, certainly the focus on government security is not long-term. This was a knee-jerk reaction. Yes, historically, if you look at the portfolio of banks, we do not necessarily invest just in loanable funds, rather in loans, lending. We still have very active investment space, which government securities now will fall into that category. We still have a very proactive payment platform, which now accounts for almost 30-40% of banking sector income right now. So we are still allowed pretty much to invest in government securities. Remember, for banks, liquidity is very paramount, and any investments in government security count as liquidity in the banks because of the ease of offloading these securities in the event that there is need for it. So banks strategically will still invest in government security, of course, for that liquidity aspect.
Yes.
But if government borrowing does not go down, and honestly, we do not expect it to come any, and ideally, we expect a lot of it to be from the domestic market, considering the volatility that we're seeing in the external market. And if the US, of course, goes ahead to raise interest rates and dollar continues to surge, then there's every reason not to go external, and the concentration on the local market then provides more opportunity for banks to make more money, easy money. They keep saying, like, lazy banking, you put your money in government securities, go tee off at some golf club and come back, you made 13-14% return on a 20-year paper. So
Yes.
unless, of course, government is very deliberate, and we've seen this succeed in countries like Tanzania, where fiscal deficits are as low as 3% of GDP, if not less. So banks have little alternative to sort of push this money to the private sector, or alternatively pay out to some other elements. Like even if you're paying dividend, then you're injecting some liquidity back into the market. But for as long as we still have that level of government borrowing, we do not expect banks to. They'll still have that avenue to lend to government security, and the incentive then to lend to take the risk on the private sector remains extremely low. So as banks, we are very keen. Of course, the private sector provides a lot more return because it's a high risk, high return. And we also acknowledge that there is still some lag effect, call it, of the interest rate controls. If you realize, most banks are still not pricing their assets above 14-15%, although we've seen some slight adjustments to that, and we still have sort of to go to the central bank for any approval to adjust pricing.
Yes.
So in that case, we'll still see banks being a lot more cautious in extending credit because they cannot price it as they believe, at a rate commensurate with the sort of risk and monitoring that's required for this high risk portfolio. And as Anne mentioned, we're still pretty much exposed to the pandemic, so the uncertainty is still there. We are hopeful that Omicron will not be as bad as the Delta variant. Otherwise, it will already be evident right now. I think also the narrative from the key sectors is starting to sort of tone down and indicate the initial fears were overblown.
Yes.
So if that is the case, then we should expect more push for banks to lend to the private sector. Ultimately, we have to see some organic growth, and therefore this remains very central to our strategy. And we are big on mass. That's where everyone has Shwari, KCB, M-Pesa. That is how we are banking the mass right now. There will be more focus towards that because considering just the scope and the sort of the size of mobile lenders in the market, just goes to tell you, if you can have a structured bank penetrating this market, as opportunity within the Kenya banking sector.
Pretty much. All right, and let me also have you weigh in on that conversation. And the meaning of resilience, does it change when you see that composition of liquid assets, 71.1% treasury bills and bonds, Anne?
I think the government really did provide an avenue for banks to invest in them.
Yes.
Remember in the 2021-2022 budget,
yes,
they adjusted the public debt to foreign debt mix. Now public debt comprises of 70.8%
yes,
versus 29.2%. So with that, and also with the credit risk that was last year, banks put more in government papers, they put more in treasury bills and treasury bonds so that they can just de-risk their portfolio. Remember, lending out to loans has a lot of risk, and non-performing loans, other people will default, but giving to a government papers are perceived to be more secure. They know that as even in 1 year, 2 years, they'd still be there. As much as we have a country like Zambia who defaulted on their Eurobond, but for these short-term papers, banks have a higher or a positive outlook, and they know, as it has been mentioned before, if I put in a 91-day T-bill or 182-day T-bill or just 4-day T-bill, I know in 1 year I'll have that money, I'll have that liquidity. It's easy to liquidate short-term papers. So yeah, for now, banks will continue to invest in government securities, but as the conditions improve, as the environment improves, now we'll see more lending to the private sector. But then again, even with the CRR that was reduced to 4.25% last year,
yes,
we've not seen growth in the private sector. Banks still perceive private sector as a risky adventure. So you'll see them now again going to government securities just to de-risk their portfolios. But should the economy improve, should the macros improve, we'll see banks, as we've seen actually in this Q3, for the listed banks that we track, investing in in government securities actually grew at a slower rate than than giving out loans. So should the macros continue to improve for next year and in the near term, we'll see now banks continue now to go back the sectors in the economy.
Pretty much. All right. And also in just a couple of minutes, two if you can, banks are in the business of business. So we should bestow them with the responsibility of growing the economy. It's just that it.
Okay. Okay. Obligations to shareholders, aspects to do with profit. So we're likely to see banks, as alluded to by my fellow panelists, continue to lend to the government. However, I think we may need to also factor in certain interventions which have been made by regional and international bodies. I earlier alluded to what European Investment Bank is doing with CoPank. It's essentially just to try and push credit to SMEs, and we've seen a couple of more such initiatives being pushed into the market. I think one thing we may also need to consider, even as we continue to extrapolate this particular discussion, the SME market. What banks have also done, apart from just lending to the government, we've also seen a lot of profiling of clients, classification and profiling of clients. So certain aspects, certain parts of the economy will still get credit,
yes,
based on their performance and based on their projections. However, I think we may need to, as an economy and as a banking, as the banking sector, we may need to properly implement intentional items which have been placed to aid the SMEs. And as I alluded to earlier, the credit guarantee scheme, the STAWI initiative, and also such initiatives which are being done by the European Investment Bank in conjunction with the likes of Cooperative Bank.
Pretty much. All right. Now, let's get close to the end of this conversation like this now for Abraham. We've looked at 2021. We've seen where the growth was. We've seen the emerging issues around that area. So let's look into 2022. Big ones as well. Now we do know that any other person who has defaulted a loan of 5 million shillings and below will not be listed by CRBs within the economy, meaning up to September 2022, that's when effectively you can blacklist or confirm or check with a credit reference bureau on whether Abraham or Simba are good borrowers or not. That is an emerging issue. Another one is the impending general elections 2022 as well. Let's talk about the first one, Abraham. Is that going to be an impediment, therefore, to lending to the private sector or the mass market? And if not, or yes, what do you expect? How do you expect the banks to behave within the spirit?
I think it has already started to affect, because what basically you've done, you're asking the banks to shoot in the dark. So and banks like certainty.
Yes.
So you'll definitely see a lot of shying off from that.
Yes.
At a personal level.
Yes.
Compound that with elections. This is a year where banks will play it very safe. So if there's again, and as much as we talked about it at length, if there'll be room to lend to government, they'll lend to government.
Yes.
You see, they'll rather keep their money liquid or near liquid, and avoid as much as possible, especially this debt now where they can't check your credibility in terms of CRB. Yes, the measure was well meant, but you can see now the banks will look at it again from their side.
Listen, Abraham, I want to ask you that question as
Yes.
well. Did it appear funny to you that when the Central Bank of Kenya Governor, Dr. Patrick Njoroge, was officially starting that moratorium period for blacklisting for anybody who's defaulted a loan below 5 million shillings, he did warn that this is bound to take us back to where we were in the cap rate regime. Did it sound weird to you that this is a policy that didn't sort of meet the policy making process?
You see, it was well meant. But again, now it was well. You see,
Abraham, a well-meant policy means that you actually talk to the policy makers.
You see, my brother spoke of banks profiling.
Yes.
So people people had developed bad profiles based on a very abnormal year.
Yes.
So basically what we are trying to do is to see if we can put them to the period prior to this pandemic period. Because there are people whose profiles have gone very bad,
Yes.
but they're not bad people
Yes.
from a credit perspective. So that's what it was meant to do.
Yes.
But now what eventually it will do is, since there'll be starvation of credit to these particular people, then we'll see an emergence of a black market. That's for sure.
Yes.
And that black market will come in all manner of forms. Of course, the loan sharks will have their field day. As much as we want to regulate the digital ones, what about the non-digital ones?
Yes.
Those are the ones that exist a lot. So we'll see a lot of that because credit is needed. And credit has two aspects, price and access.
Yes.
Access comes first. So when you can't ask access, then people become price insensitive.
Yes.
That's why you see people taking loans of 30% a month because I need the money.
Yes.
But once access is crossed, and that's where I think we had reached. That's why we had started having the discussion of price. But now we are back. We are back to now an access issue.
Yes.
And that will play out in this election period until that moratorium ends. And the moratorium will end in September when there'll be transition. So we'll talk about normality on this particular issue probably at the end of the year.
Pretty much. All right, Faith, let me jump to you as well this morning as we went into the emerging issues that are taking us all the way to 2022. That particular policy, the moratorium for blacklisting any other person or any other business entity within the economy that has defaulted a loan of less than 5 million shillings. Well intended, but can I get your sentiments on that, Faith?
It's certainly well intended, but even from an NCBA perspective, we have literally over 200 billion exposure right there, and that is pretty much your insurance portfolio, which is quite huge.
Yes.
But strategically as a bank, and I don't know whether this is across the board, but I think that is a conversation happening at KBA right now.
Yes.
Strategically, we've decided not to freeze lending. There are other avenues from which you can determine a viability of a customer. Yes, the CRB sort of disincentivizes people to service their loans, and could mean like us extending credit to that segment is a lot more risky. But there are other initiatives that banks are sort of taking to make sure we do not freeze lending.
Yes.
So we are not too exposed to the risk that indeed presents. So there's some fair balance that is likely to happen. I think it pushes for more innovations on the banking side in terms of that's how we determine the viability of each person in terms of how their serviceability of debt. And it should make for a better 2022. With all this, what COVID has basically done is test our business models.
Yes.
Push us to sort of towards better innovation, towards more efficiency. And that is what should drive sustainability in 2022 and beyond.
Pretty much. All right, George, I just want to get your sentiments on that as well. It's a big one, it's a big policy that we did see Uhuru Kenyatta push to the industry on the Mashujaa Day celebrations, that non-listing pronouncement for any other individual or business entity who has defaulted 5 million shillings and below. How do you foresee the industry is going to react within that policy, George?
I think, Elijah, that is a good thing. If for example I was not able to pay my facility last year,
yes,
because of the COVID-19 ravages, the COVID-19 risks,
yes,
and then if you close my credit tap, so to speak, then you close my avenues of restarting my business or revamping my business. So that essentially what the president did is at least to give a pathway for most SMEs, because most SMEs are the ones that are affected in that space, to at least get credit that they can use to pump back into their business and at least get back to where they were pre-COVID-19. So I know that is short-term, yes, but it is a good thing, and it is going to at least revive most of the SMEs that otherwise would have gone under with the COVID-19 pandemic. I think without alluded to that most SMEs just didn't go down in business, but some of them actually closed because they were not able to sustain the COVID-19 pandemic risk.
Yes.
But at least with this, they have a pathway to restart again, restart their businesses again, so that they can recover to where they were in 2019 and pre-COVID, Elijah.
Yes, George, just before I let you go on that, you're taking a slightly different perspective from what Faith and Abraham have actually spoken about. But then the banks, George, if you were a banker now, is that not somebody telling you, well, you gotta lend in the dark? You have to be sure who you're giving your credit to.
Not actually, Elijah. The way listings are done, the only thing that is changing is that I'm not going to be listed as, I'm not going to be given a negative listing. Otherwise, all loans as they are today, Elijah, are listed with the Credit Reference Bureau.
Yes.
So if I had a loan of 5 million and I defaulted, the only thing that the president did is that I'm not listed as a negative on a negative scale.
Yes.
But still, that facility is still in my CRB records. So for a banker who is looking at my credit history, they'll want to know this facility, what did you pick it for? Did you manage to pay it back? If you didn't manage to pay it back, what were the reasons? So that forms part of their due diligence procedure as they look into giving me a second or third facility, Elijah.
Yes, pretty much. All right, quickly, let me cross over to Anne. Anne, a big pronouncement by President Uhuru Kenyatta on Mashujaa Day celebrations. Looking into the industry, how do you expect them to react in 2022, Anne?
The directive was a really good move, more
Yes.
so to borrowers, given that they know they now have more time to repay their loans and restructure their loans.
Yes.
But if you look at the banking perspective, as George has said, banks will now have to be more proactive, given that, yes, your loan is still listed, but it will be hard for banks to distinguish between good loans and bad loans, given that they can't really see from their end if you've defaulted or anything. Now they'll have to come up with new structures, with new measures, just to know, just the due diligence part of it, they'll have to improve it so that they can know if I'm lending to X and X person,
Yes.
do they have the ability to pay it back, or will they default in the near future?
Pretty much. All right, Arnold, clear that conversation this morning. I know I spoke to you when that pronouncement was made. Arnold, have you changed your view that probably this could be good for the economy?
I think I still feel it was a roadside declaration. But at the same time,
what you used when we spoke.
Honestly speaking, at the same time, simply because of the practical aspects of dealing with such declarations.
Yes.
Now, I resonate with what Anne is talking about. It simply means, as a bank, you may need to enhance your appraisal tools when dealing with such clients, because
yes.
any sort of blanket declarations leaves leeway for so many possibilities. And for prudential lending or facilitation of credit facilities, you only need to further look into your appraisal tools. Again, the effect it will probably have on the ground, I don't think banks will just take it up quickly. Banks will still be very cautious. And based on the discussions we've been having this morning, we'll still see a lot of these banks just being cautious on how they deal with such clients. So a good move on paper. And the intention is to basically just to try and avail credit to the MSMEs or clients who may fall into that particular bracket. But at the same time, the onus is on the banks to look at the appraisal tools and basically just safeguard their position.
Pretty much. All right, last rounds. Therefore, as we close 2021, all right. Now, Abraham, if you look at the GDP growth rate in all the way from 2017 up to where we are in 2021, I don't know even whether you have that data for the GDP growth rate, the quarterly GDP growth rate. So we're gonna actually take a look at it, because there's a very important conversation that it will come out of that this morning. Yes, there it is, George. Sorry, Abraham. Because if you look at where we're in 2017, 5.2 went to 4.4. 4.5, and then we went to 5.1. You will say those were the effects of the electioneering period within when we were deep within the elections. Fine, we have that data scored there. The coronavirus pandemic did come in, which was the biggest threat to Kenya's economy after the election in 2017. And within that, we said the banking industry was quite resilient. But then, Abraham, we've actually seen that indeed there is a big disparity from banking industry performance and the economic growth. Is that what we're looking at 2022? Are we saying that the electioneering period might not really affect much the growth of the banking industry, given that, as it is now, I mean, 71.1% of the liquid assets are within treasury bills and government bonds?
If you look at these numbers over even a longer period,
yes,
there's always a disparity.
Yes.
And the main reason is that the bank data, with due respect to banks, is much more accurate than the government data. For this reason,
yes,
most of the businesses in Kenya are not documented, but they are banked.
Yes.
So they don't appear on the economic radar, but they appear on the banking radar. So the performance of the banks is as a result of the interaction with the economy as a whole.
Yes.
Our economic indicators, because the models we use, of course, are models that are World Bank models, IMF models.
Yes.
Are very driven by, are data heavy, are driven by data and how data is collected. We all know that how SMEs operate. Some of them are completely below radar. So that's why you see that, because ideally those two numbers should be very close to each other. Because don't forget, banking is a pulse of the economy.
Yes.
Because that's where all the birds come from.
Yes.
But for this particular economy, because of the informality of it, probably up to 50% of it could be below radar in terms of being counted.
Yes.
So the banking performance, as you can see, during this period, it went up and down.
Yes.
And because it had a pulse of the economy, because every SME, no matter how small, they are banked in one way or the other.
Yes.
That's how well bank people are. But when it comes to the economic collection data, most of the people are not counted in terms of what they're doing, what they're up to, how much they're making. But banks have a clear indication of how much you're making, because they're the ones who keep it for you anyway. So for me, I would, if I was to compare those two data, I would rely more on the banking data.
Yes.
Than on the economic one.
Pretty much. All right, let's take the last round of response from you, Faith. And then, I mean, when you look at that economic, that is the GDP growth, the growth data, and then how the banks have also grown within the electioneering period and the COVID-19 pandemic period. Faith, should we worry more about COVID-19 or the electioneering period? Quickly, if you can, so that we wrap up.
All right. Thank you, Simba. The relationship between banking and the economy is like the cat and mouse. Sometimes you don't know which one comes first. The banks do benefit from a strong economic environment, but they also propel economic growth by availing credit.
Yes.
So should we worry about the Omicron or the electioneering period? Statistically, and I have looked at the numbers, honestly, there's still there's no clear evidence to suggest that indeed activity slows down during elections. Sentiment tend to suggest so, but statistically, you cannot prove that. And I looked at this quite recently. What happens as the election environment shapes up? Of course, investors will adjust to how it's playing out and the likely outcome. It sort of helps that we have stronger institutions today, where we have some fair confidence in the judiciary in sort of resolving any election discourse, and therefore that confidence helps when planning for any investments or consumption for that matter. And I think as a people, we maybe this is biased, but we are so much tired, and the COVID period has been so difficult. We just want to move on with our lives. How elections play out, at the end of the day, I just need to know how I'm going to get food on the table.
Yes.
So will the election have an impact on growth for bank of course, and the economy generally. It should just some slowdown. What it happened, it probably could delay some investment, some consumption, but this should certainly come back and a lot more strongly once we have the new government in office. I do not expect we'll have a chaotic transition, and that I believe should be good for the economy generally. And certainly, if the banking, rather the economic environment is stable, if sentiments are optimistic, then certainly the banking sector could as well ride on that. So certainly, I'm very positive about 2022, unless of course the Omicron is much worse than the Delta variant.
Pretty much. All right, we have less than a minute. George, let me get 30 seconds response from you. What should we be looking forward to, the general election or the threats that the COVID-19 pandemic faces the industry with?
I think Elijah, COVID-19, I think we've coped with it quite well. If you look at Kenya vis-a-vis our compatriots.
Yes.
If you look at the global economy, Elijah, the global economy contracted by 3.2%. The more advanced economies, that is the bigger economies, contracted by a whopping 4.6%. Sub-Saharan Africa contracted by 1.8%, yet Kenya grew its economy by 0.6%. So that tells you that Kenya as an economy is really a one, and we expect a growth rate of around 5.4% this year. So I think in terms of 19, we are at a space where I don't foresee the risk is still there, yes, but I think it's a risk that we can manage. My only fear, Elijah, is that we are going to have two major risks in the next 3 or 4 quarters. That is the COVID-19 pandemic, especially the Omicron variant, and then our election that is coming up. Our election has been a bit of a challenge over the last few cycles, but I believe this one will be much better than what we've had before. If we can be able to manage those two, Elijah, then I believe we're in a safer space as we go into 2022, Elijah.
Pretty much. And 15 seconds from you. COVID-19 or the election in 2022?
For me, I think banks will be more concerned of the variant, given that COVID-19 was actually worse than the environment that it put Kenya. It was worse than any election.
Yes.
So for banks, they'll be more concerned about just managing the pandemic. Yes, the two risks will coincide, but banks will be more concerned about how the variant will affect their books.
Pretty much. Arnold, clear this 2021 conversation as we look into 2022. 15 seconds for you. COVID-19 pandemic or the general election in 2022 that generally just shakes the Kenyan market?
I think we may need to assess both, but I feel that we will do better as far as adjustments with COVID-19 are concerned. So I think the focus will be more on the general elections and the impact that it has on the economy. My take.
Fantastic. At this point, let me say thank you very much to Faith Atiti, Senior Research Economist, NCBA, George Munga, Economist and Analyst, and Managing Partner, AMG Kenya, Anna Wasera, who's an Investment Analyst, Saiton Investments. We have Arnold Nkosala, who's a Microfinance Banker, and Abraham Mudhogom, who's a Financial Expert and CEO, Mirwadi Capital. For us here at Metropol Television, we wish you a very, very, very Merry Christmas and a prosperous 2022. Good morning and goodbye. at Metropol TV KE across all your social media platforms, on our website www.metropoltv.co.ke. My name is Simba Elijah Charles Kiage. Welcome to yet another edition of a Business AM. Let's introduce the subject that we're talking about this morning. I mean, it's slightly above 200 days to the general election. That is the August 2022 election. So the question is now, how is the current political environment affecting business or going to affect business and economy in the coming few days? Now, Kenya generally has a history of where the economy assumes a wait and see approach every time we gear towards the general election. Is that the same thing that we are going to expect this time around? Is that the same thing that we are getting this time around? That is a question we are asking as we come to the end of 2021. And in the studio this morning, I am joined by Cliff Utega, who is a policy and governance analyst. Cliff, good morning, sir.
Good morning, Simba, and thanks for having me on. No?
Anytime, man.
Yes. Okay. So there's a number of things we want to unpack today.
Yes.
Okay. And one of the best predictors of what we'll see in the future is what has happened in the past.
Yes.
Okay.
Yes.
So just recently, last week actually, we listened to the president give his State of the Nation address 2021.
Yes.
And one figure that stuck out that analysts are still debating today is he told us that in 2017, after the elections, the Kenyan economy lost 1 trillion shillings. It's a huge figure.
That's a huge figure,
it's
isn't
a
it?
huge figure.
Especially after the 2017 election.
Yes. Because of that stalemate that we
Yes.
had with the nullification and, you know, the street riots and violence and that back and forth
Yes.
until what we now know as the handshake.
Yes.
Okay. So in an economy that today, the president also told us, is worth 11.1 trillion shillings, you know, GDP.
Yes.
That means that in 6 months, we lost close to 10% of our GDP.
And that's a huge figure,
number.
Cliff, especially when you look at how the economy has been growing, isn't it?
Yes. So when you look at it like that, we're not a rich country, of course, yeah? Our GDP is impressive by East African standards, but
Yes.
that's a low base. And we know that the GDP per capita for Kenyans is hardly, you know, about 100,000 shillings per annum. So we were already struggling before 2017, and you can imagine we wiped out 10% of our GDP. If that is repeated after 2021 for whatever reason, then we're in big trouble. And there's a number of reasons why we'd be in very big trouble.
Yes.
So one of the reasons, and I think we need to start with the elephant in the room, is our debt crisis. I'm calling it a debt crisis. Some people are a bit reluctant. They're saying, no, we might have overborrowed. It's just a matter of how you pay. But today I'm calling it a debt crisis. And this is why. Currently this week, we owe 7.7 trillion. Okay, to domestic and international lenders, you know, of whatever class, bilateral, multilateral, and that sort of thing. Now, the challenge with that is that we're already seeing it in the way that our country operates. I saw an article yesterday that our secondary schools have only received half of what they call capitation, basically the funds to fund public education. They've only
Yes.
received half
Yes.
of what they're supposed to receive for term 2. Our universities are bankrupt. I think we've all seen
I
that.
think that we've all seen that.
Yes,
Even
more
the capitation they've
universities
received
closed.
now
Yes.
is only accounting for 49% instead of
Yes.
the 80% it's supposed to account for.
Yes. And those are just basic examples, okay? They're more intrinsic things around our salaries being paid on time. Is the government able to deliver services that they need to deliver on time? So that's a big problem for
Yes.
us, okay? And that can only get worse. And I'll give you an example. Zambia, which is one of our regional neighbors, just had an election in August, okay? And at that time, they were in a similar situation to us debating this debt thing. When the new president came in just a couple of months ago, they've taken an example, and nothing against China, but they've just taken an example, and they've said that the disclosed debt, Chinese debt in Zambia before the election was $3.6 billion. After the election, and they've done their math again, that number has shot up to $6.6 billion.
It's double that figure.
Yes. So in Kenya as well, there's been a long-running debate, especially over the last couple of years, of how much we truly owe. Because there's not just the debt that we have on our books, international debt and bonds and that sort of thing. The government also underwrites the parastatal debt.
Yes,
Okay, yeah,
yes.
because parastatal companies obviously are ultimately government entities.
Yes.
So we're also underwriting that. So there's a big back and forth about how much we really owe. So we have to get a grip on that. Whatever happens between now and the election and immediately after is so important about how we manage our debt. Now, there are two ways we can do it. Zambia today have gone back to the IMF. You know, that's basically a begging bowl. You're asking for a bailout. IMF comes with austerity. So you stop spending and we lose jobs, especially public sector jobs.
Yes.
Or we can have what we call the Hail Mary approach, where we do a complete economic restructure. And then we look at some form of reorganization of the economy.
Yes.
And this is where politics comes in. So we have two sides of the political divide now. One side is talking about a bottom-up approach, okay?
Pretty much.
Yes, so that to me is like an economic restructure.
Which is exactly what I
Yes.
wanted to get into, Clay. Just
Okay.
before we look into that, I know we're talking about what the effects of the politics would be in a 2022 for business and the economy, but I want us to go back and look at exactly where we are in terms of those GDP figures, and we're going to compare 2017 versus the COVID-19 pandemic. So we can look at it and then say which one is a bigger effect. If we could actually just go back to those GDP numbers, we have them there right now. Cliff, if you could just look at them, you will see exactly what 2017 was. That's when we experienced what we would like to call the slowest growth rate within those quarters, because you see we started from 5.2, went back to 4.4, and then went to 4.5, and then rebounded to just 5.1. You will say the effect of the coronavirus pandemic, because if we go back again to years like 2018 and 2019, you will see that's when we have what you like to call a healthy growth rate. We're touching the 6.5% mark. But then if you go to the next one now, again, in terms of those GDP numbers, you're going to say that we closed 2020 with a contraction of 0.3%. That's when our economy actually was on the negative. Question that I keep on posing to all political analysts, especially when we look at the economic growth, the effects of politics vis-a-vis coronavirus pandemic. Are we saying that with the debt situation that we are right now in this country, that bad politics in 2022 might come worse off than the coronavirus pandemic has been to the economy?
We can't tell, and we don't want to be too pessimistic.
Yes.
It might not be as bad because Corona was something that hit us hard.
Yes.
It was unknown. It
Yes.
was uncontrollable. It's still uncontrollable
Yes.
now. We're talking about ways to mitigate it now with vaccines and that sort of thing. Okay. With politics, it is within our control.
Yes.
But the problem is it will exacerbate what Corona has already done to our economy.
Yes.
Because how do we get out of the coronavirus pandemic from an economic perspective? We need to open up the economy,
Yes.
and I think we've started to do that, but people are cautious, okay? Because you're opening up the economy now, but you're already dealing with a population that is highly risk averse because savings have been wiped out, at household and farm level. And also there's that trepidation that comes with any election period. So what we needed to do to get out was to get out of the pandemic and start to regrow our economy.
Yes.
Was to give the business environment confidence, in business people and wananchi as well,
Yes.
to give them the confidence to go out and make the sort of investments that our economy needs to grow.
Pretty
So
much.
of course, if we do our politics as we have always done it over the past 10, 15 years, where we begin with very negative rhetoric, we are dividing Kenyans maybe around ethnic lines and that sort of thing, then what do people do? Naturally, you pull back from investment and you say you adopt a wait and see attitude. So we might not see, and we hope that we don't see that
Yes.
sort of contraction,
Yes.
because that one was largely about people, not being able to work and being basically locked up in their house and that sort of thing. Here, we're dealing with the mindset. Okay, so people are saying, I prefer to wait till 2023 and see what happens. So we may not, and hopefully we don't see a contraction, but I think we'll see very tepid growth as people focus on
Yes.
the election.
Another question again, Cliff, when you look at approaching 2022, and I know you're pretty much astounded when Ukuri Yatani came on the other day and said that if he says that things are all right when it comes to the way that the government's debt accumulation is going on, he actually said he will be lying. When he was telling Uhuru Kenyatta, with the way things are going, declining revenue growth and the sluggish economic performance, then we are at the red line. Is our debt a political issue, Cliff?
I think it's the biggest because
Will you blame it on Uhuru Kenyatta and that's it? When the treasury says, he's given him that job. So we like to think that even before we accrue that debt, then there's a back and forth process that goes in on exactly whether we can actually be able to accommodate it. The projects that we're running under right now, whether we can actually be able to accommodate them all the way to 2022. So when your boss comes in over the other side and says, hey, Cliff, the way things are going, man, it's not good. Is Uhuru Kenyatta pushing so much for his project that he doesn't care exactly what happens after 2022 because he pretty much knows it'll be out?
I would hope that's not his attitude, okay? But if we're looking to blame people, okay, and I don't like a blame game, but we must, I would think about it as let's ascribe responsibility to different parties.
Yes.
The first group of people that we have to look at is our parliament. We have very well-paid parliamentarians, and this is one of their key roles, okay, legislatively. There's a finance bill that they're presented with every single year, and they need to analyze it. It talks about our revenue, it talks about our expenditure. They are the first group that we have to hold responsible. But you're right, ultimately, because this is a government, and these are separate arms of government, the buck must stop with the executive because they are the ones that ultimately propose the projects. They are the ones responsible for implementation, and we have to hold them accountable. So we've had such a huge focus on macroeconomics, and we can debate, and I think we will debate for many years, if all these thousands of projects were really necessary at that time and at that pace and at that cost. Okay, so that we must also lay squarely at the door of the executive. So if you want an answer, yes or no answer, of course, yes, then the buck stops at the office of the president. Yes.
Pretty much. Now, you were talking about how we are gearing ourselves for 2022. And Cliff, I want you to be honest with me, because indeed, yes, now there are the two sides that we know that are leading for 2022. Raila Amolo Odinga, as we speak right now, we do know that he's at Kasarani holding that rally for his presidential bid for 2022. When you listen to the politics right now, and I know we're going to look at that data set this morning and try and fit it somewhere. And if you could actually give us that data for credit to the private sector, so Cliff can actually lay that argument on that area. Again, yes, we might look at those numbers, good numbers, healthy numbers in terms of billions that is going to the private sector. But then if we move to the next data set then and talk about it in percentages now, that is up to November 2020, even if we could jump into the next one, then you're going to say, yes, that's the same data set. Let's talk about percentages now. This 2021 around the same area as well. You can see not much of an improvement in terms of the credit that's going to the private sector. All right, let's move on to the next one in terms of percentage. Now that's where the conversation comes in, Cliff. Single digits. We are in 2021, but we've not even crossed to double digits in terms of credit to the private sector. Now, if you look at these two factions that are gearing for 2022, do you think that these conversations about bottom-up, I don't know what Raila Amolo Odinga has for us as well, do you think that indeed they have solutions to the growth of the economy? Because for a very long time, Cliff, our politics have been not policy-based. You and I do know that. When you look at these two factions that we have right now, do you believe that we have a policy in terms of them going for office in 2022?
I'd say yes and no. Yes, because if we look at the bottom-up economic model that has been proposed, by, I guess we call them the Hustler Nation, because that has been rolled out over a period of time, it's beginning to crystallize. So
has it been, Cliff?
In terms of how it's been rolled out to the public. So we have a number, like even yesterday I watched a clip and I heard the deputy president say that they will direct 100 billion shillings to uplifting certain groups of people. Okay,
Cliff, just hold on there. When you look at this promise, that the bottom-up approach, is it not the same one that the 2010 Constitution is promising Kenyans, where the single most valued growth line for the economy is the word? So we're sort of approaching it from top. Is it the bottom-up? Yes, we're approaching it from the word up to the national level. Is that not what it is?
So if it is, then the answer to that question is then why did we not begin to implement that? Because in 2013,
Yes.
when we had the first new government that
Yes.
was basically under the new constitution, we went completely opposite, and we approached our economic growth from a macroeconomic perspective.
Yes.
We looked at it, and I've heard people say it again. It was infrastructure, infrastructure, infrastructure. So we said we're going to make a massive bet, okay, on one item, for example, the SGR, and we said let's spend 6 billion. 6 billion shillings on that. Okay.
Yes.
Yeah. Or sorry, 600 billion
Yes.
shillings on that. $6 billion dollars. Yes. And then that is going to be something that is going to have a domino effect on the economy. Unfortunately, we're not seeing that. So we must go back, okay, to basics and understand where we went wrong. So this bottom-up model then looks at obviously overturning that. And I've seen, because we watch these commentaries and they're beginning to explain themselves more and more and more.
Yes.
And I think I would urge the parties now to come out with their written manifestos so that those can be interrogated. Because if you're saying that you're going to use from the same bucket, are you telling us that now you would not, in the next 5 years, build something like the SGR or extend it, and you would now take those hundreds of billions and plow them into the economy at a macroeconomic level? If you're saying that, you need to put it down and we need to interrogate that.
Yes.
And to interrogate it, I'll give you an example. You see, like in the US, they have a congressional budget office. When you make policy proposals like this, both sides of politics, okay, then they do an in-depth analysis and they cost it and they align it to the budget and they tell the public it openly, this actually is possible, or this would be the impact of your proposal on the economy.
Yes.
We're not doing that. We do
Yes.
have a parliamentary budget office, but I wish that they could come out boldly and also cost these proposals, because otherwise we're basically it's a stab in the dark, and we don't know what will happen until you've actually gone in and implemented it, and then with 5 years later we are waiting for the outcome. But the problem is now
Yes.
we don't have that room to guess.
Yes.
We just don't have it. So we have to make a very clear decision. Either we stop building infrastructure at the rate at which we're building it,
Yes.
and then direct that fund or those funds to this bottom-up, or whatever you want to call it.
Yes.
Because I
Yes.
think even the Azimio side of economics is talking about a similar thing. Although the only pronouncement that we've had from the former prime minister is he's said 6,000 shillings to every needy individual or household. Okay, and I think the figure has come to about 140 billion a year. Not too different from the 100
Not too
billion.
different from the 100 billion, is it? Yes.
But we don't know what the impact is. We
Yes.
can analyze it
Yes.
ourselves,
Yes.
but until they tell us where the money will come from directly. So we need to look at our budget, say from last year, and say we budgeted, say 1 trillion on infrastructure. So now we're going to cut that number down to 600 billion, and then we'll plow 400 billion into this other approach. Without that, it's a stab in the dark, and
Yes.
I fear that we could end up even worse than where we are today.
Pretty much. Just before I ask you just to tell us about what you feel about the economic climate now and the political climate as we approach 2022, I just want us to look at the next data set that we have this morning, our expenditure versus GDP growth rate. If you could show us that data, so that we question whether we need to change that model as we move into 2022. Just the next data set, if you could, the expenditure versus GDP contribution, because we've already looked at Kenya's GDP annual growth rate. Just as we wait for that data, because there's a very nice conversation point. If you could move on to the next data, expenditure versus GDP growth rate. You have it? All right. Just as we wait for that data set to appear, Cliff, we are moving into 2022, and every single time our economy stops, Cliff, do you feel that this time around it's different, especially after the failure of BBI? Did we go back again to where we were in our formative years again if we did not pass BBI? Do you feel that we have the confidence that this is going to be a clear-cut process and we'll come out of it saying that the economy did not suffer any other jitters of the election?
It's unlikely. It's unlikely
Any
because
telltale signs?
yes, the telltale signs are already, like we had said, we're coming out of a once-in-a-generation pandemic.
Yes.
Okay,
Yes.
so already business confidence is shattered.
Yes.
Recently, we saw a statistic I think it was a CBK report where they said 35% of MSMEs in Kenya were wiped out over the corona. It's not that they're faltering or whatever. They're gone. Those businesses are gone.
Completely.
Okay, completely.
Yeah.
So now you already have that 35%. And remember, these MSMEs are responsible for about 90% of the employment in Kenya. Okay, so those are gone. 35% are gone. Now you take people that are already struggling, and then you rush them into an electoral process, or not rush them, but you move them into an electoral process, okay? And it must be divisive, because that's how elections are fought in Kenya. There must be an antagonist and a protagonist, okay? And we don't have a clear pathway that gives business people confidence. So for example, look at the IBC. The IBC to me seems to be floundering. They had asked for a budget of I think 40+ billion. They got less than half of that. You saw what happened with the voter registration.
Yes.
People blame it on apathy, but it was also very poorly rolled out. I can tell you because I also concern myself with politics in my ward where I live, okay?
Yes.
Kileleshwa. Out of 5 polling stations, there are only 3 of these BVR registration kits. So it was like a cat and mouse game to try and get that registration going. So the IBC are blaming that on a funding issue. Okay.
Yes.
Then you saw somebody went to court and said, let's extend this. And they said, okay, we extended it. Then they were spending I think 2 or 3 million a day in that process. So it's a total mess where we are now. And then now we are awaiting yet another registration period in January. So all this stop-start, what message does it send to the economy? And then you have, I think, what is going to be the longest campaign season in Kenya's history. The IBC again has said people are campaigning prematurely and it's an election offense. We're not seeing any change. When you look at the number of people that are drawn by politicians, the political crowds, doesn't that make you sit up and think, wow, what do all these people do apart from, like, what could they be doing on a Tuesday afternoon? Gidura is a famous place. We've seen that a number of times.
Yes.
Everybody goes there.
Yes.
Where do those people come from? Do they not have gainful employment, which is what we would expect on a Tuesday afternoon? So you asked about telltale signs. Those are the telltale signs. The political rhetoric that keeps ratcheting up. IBC not itself expressing confidence in terms of the way it's leading the electoral process, and then the ability of politicians to master tens of thousands, or maybe exaggerate a bit, but thousands of people, at the drop of a hat. That tells you that we do have a problem in terms of where the economy is heading vis-a-vis politics.
Pretty much. So lastly, as we come to the end of this conversation this morning, again, talk to me then about how you've seen the two factions relate. We have a very, we like to call a unique setup as we go into 2022, when you have the DP, who's part of the government, criticizing the same government he is in for not delivering promises to Kenyans. That sort of setup, Cliff, does it give you confidence that we've matured politically to the point that our political ambitions would be sort of geared towards developing the economy, or is this politics for politics? I want to get there, and that's that. I want to prove that I can actually win. Have we moved away from that? And how do you think, Cliff, again, we're going to be, we want to make our politicians more accountable. Has our economy grown to that point where we'll say, well, you promised us this, we haven't seen it. And this government, to be very particular, promised a lot, Cliff. I mean, look at the manifesto. Yes. It was spectacular. We said, this is it. Have we grown to that point where we're making these politicians accountable? Or we are still that economy where if you don't get the right leader who would actually live on towards delivering the manifesto, then it becomes nothing after 10 years or 5 years of them being in government?
So I think we're not there yet. Politically, we're not, because one of the things that, to add to your observation, not only is the DP criticizing the government that he's still part of, the opposition leader now seems to have taken up that DP role. Okay, so it's mind-boggling. You know, this is fodder for political analysts, because it's something that we haven't seen, in Kenya before. But the challenge we have is we still have that what they're talking about with the BBI process, that winner takes all mentality. Okay, and it's a fight. It's like do or die for both political factions. I don't think it should be like that. And perhaps maybe one of the things that the BBI intended to do, but towards the end did not seem to actually be headed towards, was to find a way to cushion losers so that we would end the culture of winner takes all, and the people that did not win just ending up with nothing and losing face. But I don't think towards the end, the BBI morphed into something else, okay? And it looked like it was something that was only being structured for this 2022 election. That's how it looked, you know?
Yes.
Yeah, whether that was because of the politics for and against it, that's how it ended up being in the minds of many Kenyans.
Yes.
So we're not there yet. And one of the challenges for any politician is, especially if you've been in office for a long time, okay, which all of our politicians have, is how do you justify putting yourself forward as the person to change Kenya when you've already had 10, 20 years, in some cases 30 years to do that, and you have not demonstrated that you can do that credibly? It's a big thing, and I think that's why we have a political campaign season. So I want to be an optimist, and I want to say, look, then because there are no other takers, if we had like some sort of political messiah that had come onto the scene, okay, you know, like how Barack Obama burst onto the scene in the United States. If we had that, then we can rally behind such a person. But now we are Kenyans, we have nowhere else to go. So we have to make what might be a difficult choice for many. And the only way to do that is to listen to what they're saying, but we must interrogate. This time, Kenyans must interrogate what we're being told.
Pretty much. All right, in 45 seconds, as we clear off, 2021 is pretty much done. We're going to welcome in 2022. What would give you confidence that the economy might not get into jitters in the early stages of 2022? What must the current government do just to contain the election jitters that normally grip the economy just before we get into that Augusta date?
Okay, so there's a number of things, but I'll just summarize them. Number one, there needs to be a laser focus. Sort of a way the government itself needs to focus back on the economy. One of the things that we can do, pending bills is a huge problem. It's strangling the economy. The number this as of yesterday was 423 billion. You know, that's I think it's about 3% of our GDP, okay, and almost above 10% of our annual revenue. You know, that KRA collects. Yes. That must be sorted. Okay, because that is what gives confidence. So we need to stop whatever else we're doing. No more new projects, because that to me becomes another feeding trough as we move into an election. You know, people create different projects. So let's focus, you know, on getting that 423 billion back into the economy. You can't get a better stimulus than that, Simba.
Pretty much. Cliff, thank you very much for coming by, man.
Thank you.
It was a pleasure speaking to you.
Excellent.
That is Cliff Ortega, who is a policy and a governance analyst. Yes, we shall be having him more often, especially when we open a 2022 officially. Just looking forward to how 2022 is faring on, because as far as we do know, campaigns are already here, and the businesses and the economy and the world economy is watching our politicians run around in the name of campaigning for projects, but what we do know they're doing is campaigning for office. We take a short break. Once we come back, let's look at how the banking industry has fared on in 2021. Good morning.
Hello and welcome to this edition of Icon. I'm Ji Xiaojun at the Sanxingdui Museum. In 1986, the great discovery made here shocked the world with its findings of tens of thousands of ancient artifacts excavated here. And great efforts have been made to repair and restore all these artifacts to its original shape and original glory. And Mr. Yu Jian has been doing this work for over a decade. Yu Jian has been working on the restoration and preservation of cultural relics at the Sanxingdui Museum for almost 20 years. He was inspired to devote himself to cultural relics preservation after getting an appreciation for China's rich cultural heritage at college. After his graduation, he came to work at the Sanxingdui Museum. To outsiders, the restoration of cultural relics may seem like boring work, but Yu loves it. Through the step-by-step process, he feels he is conducting a dialogue with the people of ancient times from which he can gain strength and fresh understanding. He's also proud that his efforts give more people the chance to enjoy the cultural relics. Welcome to ICON, and so good to see you here. This is your lab.
这个就是我们平时工作的仪器检测的环境地方。
Well, somehow this is different from my imagination. I thought, because you restore all these relics to its former glory, so it would be, I don't know, in my impression must be like a workshop, but this looks like a lab using all these modern technologies, scanners and 3D printers.
我们在开展文物保护修复工作之前呢，我们需要制定那个文物保护的方案。就是所以呢，每一件文物，我们当时要做方案之前，都需要上一些仪器设备，对它的病态状况和它的保存条件做一些检测。通过这个检测仪器检测分析以后，才能制定详细的修复步骤和方案。那么这个呢，也就为了我们下一步真正的做传统修复和实际的修复工作提供一些科学依据。
My impression would be it's just like a jigsaw, all these pieces scattered around, everywhere. You don't know which one fits which one, but your job is to put separate pieces together to form a complete picture. But it seems it's not that simple.
可能你们看到的很多文物修复拼接的那个环节，其实只是我们修复过程中其中的一部分。那么你要对一件文物进行修复的话，那么你可能前期就需要有大量的研究，像金属器，你要对它的一些铸造工艺或者对它的成分进行一些分析。这个样的话，你才能够为你下一步就是我们实际操作修复动手来提供我们更好的一种方法。
Just imagine 50, 60 years ago, we didn't have all these equipments. And what did they do? Not you specifically, but what about the last generation, your masters, your master 师傅, what did they do?
传统修复可能我们就是根据它出土的文物的状况，然后根据修复师自己的一些经验，然后我们在有依据的地方可能给它进行拼接复原。那么现在呢，你加有科学仪器分析以后呢，会让你就是修复一件文物的完整性，那么更有依据，也就更有说服力。
So am I right if I put it this way? So the last generation, basically they based their work on their experiences, if they've seen enough and they knew what was right, what was not right. But for you, it's not just the theory part, it's not just the experience part. You also rely a lot on technology, the analysis.
其实呢，如果按照以前这些前辈他在做传统修复的时候，他可能有些地方他不能够复原，他可能就这个修复工作他就可能就不做了。我们现在就是通过一些仪器设备的检测，或者像 3D 打印一些科技的方法，然后把其他缺失的部位在电脑上或者在这些数据上3维数据上对它进行复原。那么这个文物修复，特别是这件器物，它能够更完整的体现出来。
3D printing technology, huh? This is something you've printed out. What if this half is missing? And how do you decide how it looks and the missing part if you're going to print it out using the 3D printing technology?
我们一般的话，如果是有那个3维扫描的话，我们是通过它的对称还原的原则。假如它的右侧是缺失的，那么我们可以通过它的左脸的部分采集3维数据，然后通过那个镜像的形式，可以把它的那个左脸的模型就直接复原到右脸上。
But what if it's not a symmetry?
如果不对称那种的话，我们就没办法进行修复了。对。
So what I'm saying is, because if you look at Sanxing Dui, the first 2 kits, and everything was broken into pieces before they were buried. And when you look at all these pieces, in my eyes, it was like, okay, jigsaws of different boxes. It's almost a mission impossible. So what's the most difficult part for you?
如果按照三星堆1、2号坑出土这些器物来说的话，因为祭祀活动嘛，所以呢，它可能被敲打和焚烧过。那么它很多船件呢，它是在坑里面是随意分布的。那么我们在做修复的时候呢，首先呢看它的大部分地方在哪里， 同时呢给它找拼对的地方。就像你说的，可能像拼图，就算一件器物它损坏因为埋藏环境的原因，那么它肯定大部分也会在一个区域内。那么这些区域内的残件全部集中在一起，然后呢再在这些残件里面去挑选，它有可能这些残件它可能是一件文物的，它也可能是好几件文物的。按照我们传统的拼接拼对的话，我们是找它的那个断裂面，基本上青铜器的断裂，它的断裂面它都有我们说的叫岔口，岔口是能够拼合对接的。那么就是通过这种一个个的对接拼图的形式，因为它出土的时候，它既有完整的器型，像青铜人头像，假如它有相对比较完整的，那我们就可以针对这种青铜人头像的造型，然后去找这种其他残损的青铜器的人头像，然后进行拼对。
So this is what you mean by the foundation of your work, basically the theoretical foundation you kept mentioning in our conversation.
就像你说的，我们原来最早的时候，传统修复这些老前辈，他们为啥能够把这些器型都能修复？不能说他们离开我们这些仪式设备，他就不能做了。其实很多时候，我们的修复都讲究修复依据。你有修复依据，有那个断岔口，能有对接的地方才能出来。就像我们1号神树，我们为啥那个上面的那个龙形，为啥我们后面它的尾部没有还原？就是因为我们没有找到它相对应的残缺的地方。那么就是我们不可能去人为的去主观去想象它，去给它复原。这样的话会让我们整个修复工作更严谨。这样的话修复出来的文物，也就是更能代表当时就是古蜀人当时就是他们铸造的这种器型。
但是出土的时候，所有的这些都是跟其他的混在一起的。
对，就像刚才说的，就是出土这些残件，它其实就是跟其他那些器物都是混杂在一起。
那你怎么知道这些是这些的？
这个就是我们可以看了，你看像这件神树上，它有这种像麻花，这种扭形的麻花状。这种麻花状的话，它就是说明，而且它的大小细致差不多，那么它肯定就是为啥它是一起的？你看，我们看它树座，它树座上它也有这种像麻花状的这种造型，
这就是依据。
对，这也就是依据。所以就是每一根上，你可以看到，假如你单独拿这一根，
是。
那么如果我们没去研究之前，可能这一根的话，我们不知道它是神树上的。
是，
就是我们现在有缺失的，可能会在那一堆残件里面，就要去找跟它相接近的麻花状的这个树干。
那我们得记性得特别好。
这个其实就相当于就是筛选
啊，
就在残件里面去筛选。
所以这两个其实是一样的，对吧？
对，其实这个人首鸟身，它是我们这个3号神树，它是有一个底座，然后有3根那个主树干，在这个主树干它是以那种麻花旋转的形式上去以后，
所以这个是你们最后拼出来的一个。
对，这个是我们拼接出来的一个成图。
你都已经拼出来了，为什么没有把它修复啊？
因为现在是这样，就是我们是先准备要给它一个大概的形状先出来，大概形状出来以后呢，我们再去根据它的实际情况，我们需要有论证，就是要对它有依据，有依据以后就可以这样做了，我们才会可能会把这件它弯的形状把它复原起来。
是全的吗？现在
的话还是有缺失，对，还是有缺失，
所以就看能不能在那个新的6个坑里面发现哈。
对，就看在新的坑里面有没有发现新的它的一些残枝或者它的一个底座。
这个是2根了，
对，这是2根，
这是第3根是吗？
这是第3根。其实你看哈，就是我们在拼接的时候，我们其实要找依据。为啥找依据？你可以看到，就是它是在古人在铸造那个器物的时候，它很讲究那个对称。那么你看这一件器物，它就是这个，它是分了2个部分的树枝出来。
是，
这里有一个树枝，然后这边有2个口。
应该这根这个是这根。
对，这根就是这根，这根就是这根上面的。
是吧？
对，因为这根的尾羽当时我们是后面去那个残件里面去找
出来的。
对，找出来。当时是这个尾羽是，你可以看到它整个就像这一件器物，它就像它的尾羽是一样的。因为我们三星堆还是出了很多这个
造型的
这种造型，然后你看这个尾羽的话，你肯定只知道它可能是鸟，就是鸟形式上面的一个部件，但是你不知道它到底是鸟形是哪个部件。然后我们当时在外面展出的时候，人人鸟身像的话，我们就是这样展出的。但是后面就是再去做研究，进一步研究工作的时候，就发现，在残件里面，它其实跟这一件是完全是能对得上的。所以呢， 而且这件能对上，那件也能对上，就说明它是
对呀，
它的形状就是这样的尾羽。
这就有点像拼图给它拼上了，正好。
对，就是这样，因为埋藏的原因，它的这个
颜色不一样了
颜色已经不一样了。但是我们可以看到，它还是保留有一个槽，这边有一条槽，然后这个的凹槽，它们其实是完全对得上的，而且它的大小是一样的。
对
而且
对
不光只是这一个人手鸟身像，它有一个这个尾部的这个尾色，然后其实这一件它也是一样的道理，
也是一样的哈。
对，所以我们现在是暂时把这一件的鸟是已经给它通过那个愈合的形式把它全部愈合在一起。那么你可以看到两件它是完全的形制是一样的，
是，
它的形制
这就
一样的
是您刚才所说的依据。
对，这个就是依据。
通
过这样的话，我们就可以知道这个人手鸟身像，
对
它的尾羽
应该什么样子，
就是这样很完整。
对，
就是我们在做修复工作中
新发现，
对一些新发现。
Can you actually choose which object, which relics to work on?
我们整个修复工作呢，应该说是根据器物的一个重要性和独特性。我们一会儿可能会看到，就是我们给就三星堆我们做的3件文物的修复。我们为啥要做这3件文物？其实这3件文物呢，它是比较具有三星堆古蜀文明独特性的。那么就是我们在做修复的时候，肯定还是有针对性的，肯定会是把那种就是更独特、更珍贵的文物，我们可能优先开展修复。同时呢，可能还有一个人就是哪种呢？就是它的病害已经很严重了，已经完全影响到它的保存状况。那么我们就也是重点需要开展那个保护和修复工作的文物。
So there is a priority list. Which one comes first? 所以这个也是三星1号坑、2号坑。
这个三星堆2号坑
，2号坑里面，但这已经给挤得不行了。
对，它就是因为它的当时祭祀的情况嘛，它就已经把它敲砸，然后被火焚烧的比较残损。
那这个如果要恢复的话，你得拿锤子给它敲吗？还是怎么？
对，所以现在就是我们因为这一件器物呢，它现在这个形态就代表了当时古蜀人他一种，就是当时埋进去的时候，它是有一种祭祀的形式，就保留了当时的一些信息。所以现在我们这件出土以后呢，如果按照我们现在的修复的话，如果要把它绞刑好的话，那么可能会对整个器物会有破坏。所以呢，现在我们对这件器物呢，我们计划是，然后不在它原文物上进行修复。那么呢，我们就另外通过那种它的整个另外一侧的完整性，给它做一个复原件。
所以这就涉及到修复的原则是什么？不一定是把它恢复到它原来的状态。
对，
原则是什么？
原则就是根据我们要在修复的过程中，既要保持它的原状，但是呢又不要再对它造成
破坏。
对
所以不一定说非得要把它变成那个最完美的那个样子。这个是刚才你跟我展示，这是什么东西？是
这件垒它复原完整以后呢，它就是这样的一个形状
啊。
那么
这个依据是哪儿呢？
依据就是我们可以看到，其实这件垒它的一侧是很完整的，我们可以看到，它从它的那个这个底部的圈足，一直到它的整个腹部和这个颈沿，它直接从上口沿到下部底部是已经是一个完整的。那么这个完整的话，我们要通过那个就是传统修复给它开模具，然后给它一步步给它复原上去。复原上去以后，因为它是一个方垒，它方垒的话，它整个的4个面它都是对称的。那么只要我们现在保留完整的这个面是特别完整，就把它的肩部，还有它的那个就颈部和它的腹部和它的底座，这些全部是完整的。那么我们通过这个完整的地方呢，就把它缺失的3个部分，然后把它还原起来。那么我们在展厅展示的时候呢，就还是要原件还是要展示出来，然后再把它那个就是
复原件，
然后进行展示，然后让游客知道原来这件器物经过复原以后，它是
原来是这个样子的。但是呢，现在因为历史的原因，我们能看到的只是这个样子。
对。
How long have you been doing this?
我是04年到了那个三星堆博物馆，然后因为本身在大学的时候就是学的文物保护这个专业，我对文物保护和修复其实还是很感兴趣，有这种热情，所以呢，这从事了有快20年这个文物保护修复工作，一直就觉得 越做这个行业呢，可能越喜欢。你会发现，就是说你修好一件文物或者保护好一件文物的话，那么你会有很大的成就感。
So what actually attracted you personally to the job?
应该这样说吧。本身呢，我们在在高校学校里面学专业的时候，就是学的文物保护这个专业。当时呢，就是我们刚学习这个专业的时候，也会认为跟文物打交道嘛，因为文物它是死的，毕竟很多时候可能你就觉得，就是说大家没有互动，就是说你会觉得很多工作很枯燥。但是呢，你这个跟文物接触以后，你慢慢的会去研究，然后你就像你拿到一件文物以后，你首先我们要开展保护修复，那么我们肯定要对这件文物要对它进行细致的一些观察，就是说像它包括它的病态状况。然后我们在做这些工作的过程中，就会发现很多当时古人在做这件器物的时候，他提供了很多信息，像它包括它的那个器物上